On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Rob Thummel. He is the portfolio manager at Tortoise Capital. Rob, the story of the week has been oil, about crude oil because of the war in Iran. We see prices skyrocketing as we speak. Oil stocks are doing well. What's the story, Rob? Because I got to say, I'm very nervous about the war. But is this still
Yeah.
a good trade to get into right now?
No, that's a good question, Todd. And as we all know, nobody wins in war, and oil obviously is all about the physical supply right now. It's about the Strait of Hormuz and the inability for oil to get out of the Strait of Hormuz and starting to back up, and it's causing countries like Iraq to decide to slow their oil production and take physical supply off the global market because their tanks are filling up and they can't get it on the ship. So the whole system is getting all clogged up, and that's wreaking havoc and then causing concern about the global oil supply and how long this will last for. So it'll be about duration and how long the Strait of Hormuz is really disrupted. But in the grand scheme of things, Todd, I think this is important. The world does have plenty of oil, and if we can get past these logistical challenges, which could take a little while, but there's plenty of oil that the oil prices can come back down, and so for that reason, I think it's good for investors to have exposure to the energy sector. But I don't think if you want to invest in the energy sector because you think oil is going to stay over $100 and be there for a while, I just don't think that that's what we're going to have.
So, what I'm confused about is that we're talking about 20% of the world's oil supply going through the Strait of Hormuz. This is not a disruption about Iran, though. Iran produces 3.8 million barrels a day. So the question is really distributing. But the Chinese, as you know, in the last 6 months of last year, were really stockpiling reserves. You have obviously the U.S. is pumping its own oil. We just get who knows how much from Venezuela. So with that, though, why is the price? I mean, is the price rising with the expectation that this is going to be a prolonged war, or is there something underneath the surface here that the traders just haven't made public yet?
Well, I don't think there's anything under the surface. What I do think though is it's just there's a concern about how long and how much oil is going to be taken off the market. So because the global oil market is, and we've talked about this, it has been oversupplied, and it probably isn't today because we've got not as much oil traveling through the Strait of Hormuz, but when we get back to normal, quote normal, whatever normal is, we probably the price of oil will probably be more dictated by just a political risk premium, basically, rather than anything else. So as a result of that, the price of oil going up is more about actual supplies that are being taken off the market, like I said, from Iraq and other regions around the world, because of the fact that the tankers cannot really distribute it. And so that if that lasts a long time, or the Strait of Hormuz gets blocked even more, then yeah, we could see higher oil prices from here. We don't think that that's going to be a long-term problem, but it could be.
So so with that, with oil and the oil stocks, I mean, obviously the big three oil companies are doing well, and they're doing well because oil prices are rising. But again, though, a company like ExxonMobil, let's use that as an example. It's a cat's whisker away from a 52-week high, and this is a stock that's still up today, even despite the market dropping today. You have Exxon, ConocoPhillips, Chevron, all trading well today. So, but Exxon does more than just gas, and they do exploration. They work in a consortium with trying to find and drill for more resources, but they do other things. I mean, is the stock price, the rise of it, is it warranted when you see oil go up to 90, or is this just a knee-jerk reaction where people think they're going to miss out on something?
Well, I do think energy stocks are boosted when oil prices do move fairly rapidly. And as we all know, oil prices have moved up, quite a bit, obviously just this year, but just this week. And so I think that's been part of it. What I'd say is, and you're right, Exxon is a fairly diversified company. It's got a great chemicals business. It's got an LNG business. It's got produces natural gas. So it does a lot. It's got a refining business as well. That's pretty important as well. So it does a lot of different things. But what I would say is more importantly is I think what investors are figuring out is they're probably underallocated to the energy sector, right? I mean, and that's where often investors don't realize it until maybe oil does something like this and goes up, and you realize that your stocks aren't going up, and why is that? Well, I don't have enough exposure to the energy sector, and so I think you're seeing a bit of a rotation, and maybe out of mega cap tech into companies like Exxon and Chevron that have high free cash flow yields, have high dividends, have some growth, and do benefit to an extent of higher from higher prices. But Exxon and Chevron don't really want significantly higher oil prices. They would rather have oil prices remain stable, not volatile, and oil prices that support continued growth in the global economy as well as the U.S. economy.
Well, that's them as a company, but the shareholders are enjoying it. So, is there a price that you can forecast or see that would have diminishing returns to shareholder value?
Well, yeah, for oil prices, absolutely. Because what you'll see then is less demand, right? I mean, it affects the global economy. It affects the domestic economy, and the demand for oil and oil related products starts to subside. And so what price is that? In the past, we've probably seen that at when oil starts to get in the mid 80s to 90s. And so I mean we're at WTI at 90 right now, right? So that's why from our perspective we do hope that some cooler heads can prevail, that some of the tensions can de-escalate, and we can get oil prices to come back down to more realistic levels where they should be, to reflect more fundamentals and less about geopolitical risk.
But with that, are you seeing more drillers? I mean, are you seeing just a capacity wildcatters going out there right now saying, "Look, we want to start drilling. The oil boom is here, especially if prices go into triple digits." I mean, is there a cost benefit there? I mean, if we hit certain prices, it's just not beneficial, or just trying to give the audience a little education here.
Yeah, no, that's a good question, Todd. So what I think the audience needs to remember, or if you haven't studied the energy sector or looked at it, the U.S. oil and gas drillers would or will and can produce more oil. They've been disciplined over the years because the oil price has been so low. You say, what are you talking about? It's $90 a WTI. That's true. It is right now, but start of the year 55. So these oil and gas drillers have been disciplined. And what that means is they're not spending a lot of capital, and they're returning cash flow to shareholders in the forms of dividends and stock buybacks. And so, yes, the prices are higher. And so, are they going to start drilling right away? Probably. I don't think so, Todd. I think it's going to take a little while. They're going to need to see a longer sustained period of higher prices. But we don't need to see $90 oil for 3 months. If we see oil in the 70s for an extent much longer period of time, which we probably will, you'll see U.S. oil and gas producers begin producing more oil. And I try to be able to. I don't want to belabor this point, but I also have to say, look, think about what I think investors need to think about is, what if we didn't have all of this U.S. oil production from shale wells at 13 million, or over 13 million barrels a day today? Just imagine how high the oil price would be. So I don't even know. It would be really, really high. It would be well over $150 a barrel. So I think that's something that all of us need to appreciate, have some gratitude towards the U.S. energy industry for being able to produce so much oil over the last several years, and can produce it into the future, because that'll help bring oil prices down, and help bring them down, frankly, faster than it would have years ago.
That's a very smart point, and you're absolutely right. I would imagine we will be high triple digits at that point. Clearly, well over 100, maybe underneath 200, but still in that range to challenge the 144 highs. So with that though, with the amount of production that we have domestically, and we're stockpiling, we're going into Cushing, we're leaving, obviously but petroleum strategic reserves, and you have all this oil that we're holding. Gas prices are going to go up. We're expecting, some analysts are expecting a 50-cent increase at the pump per gallon at the pump next week. Truly amazing. If the war continues on for a few weeks, Americans are going to have to face that. So will we get into a situation where we will be able to release some of the reserves to try to bring those prices down? I mean, what's the forecast show you?
The-
What's
the-
your
the-
crystal ball show you, I should say?
Yeah, no, that's possible. You're right, and gasoline prices are really important. We all know. I mean, we've lived for the last several years now. I mean, with low gasoline prices, primarily because of the U.S. shale industry. I do think you're going to have to see. I mean, you're right. Prices, the gasoline prices are going to go up. When oil prices go up this quickly, this fast, gasoline prices do tend to follow a little bit slower lag. Now, look, we're at a kind of a good time period, I guess, if there's ever a good time period for this, because it's not the middle of the summer, it's not, the upcoming driving season, it's not the Memorial Day or Labor Day holiday. So there's some time for gasoline prices and oil prices to settle down and gasoline prices come back down and be that $3 or below, which I think they can be in a more normalized environment. So that's what honestly at Tortoise we are hoping for. We want lower gasoline prices for everybody, so that everybody has more income to utilize and spend on other things other than just gasoline, basically, and oil related products.
How about on natural gas? So, as you know, in Qatar, they had to close a plant because it was bombed. Evidently, I guess it's presumably
Yep.
by Iran.
By a drone. Yep. Yep.
Yeah. So, I mean, what are your thoughts there? Because natural gas is rising, but are we at a benefit of the calendar because we don't have as many cold months ahead of us? I mean,
Yeah.
what do you? Is this still a solid trade to consider?
Yeah, well, I think that's you look at what's happened to European natural gas. If you haven't looked at that, you should really take a look at that. European natural gas is up 80% since the beginning of the year, and European
Wow.
natural gas prices it's phenomenal. They're 5 times higher than what they are here in the U.S. We're really lucky in the U.S. and really fortunate to be energy independent, especially when it comes to natural gas. So much natural gas that, as you know, Todd, we export a lot of natural gas all over the world out of the U.S. Once again, same testament again to the U.S. shale producers who have unlocked all these new forms of natural gas supply. So yeah, natural gas prices in the U.S. have gone up, but nowhere close to what they've gone up in Europe. So the U.S. really has a competitive advantage in oil and natural gas in being the low cost producer, which I think can really help in the future. And when we get back to normal, especially with the low cost natural gas helping fuel the economy. And as we look forward, as we've talked about before, if electricity is the new oil because of AI, and we're gonna need more natural gas for electricity production. The U.S. There's a lot of natural gas in the U.S. and the U.S. is one of the lowest cost producers, so the U.S. will have that competitive advantage to be able to continue to produce low cost electricity linked to low cost natural gas, especially relative to European prices or in Europe now, where, like I said, prices are for European natural gas are 5-6 times higher than what they are in the U.S.
That's incredible. The EIA had reported that we have enough natural gas off of our shores in the US to heat every home in America for the next 10 years. So, if that's the case, do you anticipate that the Interior Department will be granting leases? I mean, nonstop, especially with a pro energy administration, that we might see more offshore drilling of natural gas that we could supply to our European partners?
Maybe more in the Gulf of Mexico, but I don't really know if you really need to even grant offshore drilling. Frankly, a lot of it is in these shale regions, in the Marcellus Shale in Pennsylvania, in the Haynesville Shale, northern Louisiana, in the Permian, where there's more oil production. There's just a tremendous amount of natural gas all over this country, and frankly, there's a lot of natural gas in Canada as well. So that can be, with the U.S. owning the largest pipeline network in the world, you can bring a lot of that natural gas as well from Canada as well if it's needed. So I don't necessarily think that you're going to see a massive amount of capital expenditures. I think you'll see it'll probably increase on natural gas in particular. I don't think you'll see a ton of extra capital being allocated to natural gas only because the price is still only $3, and so it's producers can earn a return, but we're not talking about, like I said, $15-16 like it is in Europe.
Yeah. It's not the Gatsby era,
Yeah,
obviously.
yeah.
Let's turn the page here. I want to get your thoughts before I let you go on electricity. Now, we heard this during the State of the Union address, where the president talked about how data centers were trying to figure out a way or partner with these companies to try to figure out how to create more resources. How do you see the future when it comes to these data centers? You have these things popping up everywhere. The overhead costs are low, profit margins are at 90%, but the draw on the municipal utilities is really an issue, and it's just going to
Yeah.
continue to be an issue, especially as costs go up. How do you see alternatives? Do you see something else that might step up to help, I guess, provide the electricity for these data centers?
Yeah, I think what was made pretty clear by the administration, it says BYOP, bring your own power if you're a data center. So don't expect the ratepayers or the citizens of in that region to pay for your data center. And instead, you, the hyperscaler, Amazon, Google, Netflix, or sorry, Meta, you need to bring your own power, and you need to have a contract and provide your own power generation. And so we're seeing a lot of that across the energy sector. Williams has done some really interesting things, some innovative solutions by using its natural gas pipeline network to generate a lot of, or well, to build electricity power plants that use natural gas from its pipeline network. And then they have contracts with these hyperscalers, fixed price contracts, long-term contracts. It's kind of like some of this is kind of like the modernization of infrastructure, basically, that's happening, I guess, with these data centers being at the center of that. But this bring your own power is going to be a concept as well. We continue to see more. You'll see more and more of that, we think, and more. There's tremendous opportunity for the energy sector to participate in the increased demand for electricity and be a power solution provider. And that's really an opportunity for the entire U.S. energy sector, including the U.S. energy infrastructure sector going forward.
Will we see tax breaks? Do you believe that where solar energy? I mean, it was such a big
Yeah.
deal 10 years ago with major tax breaks you were able to get. I mean, and homes actually that had installed them became like almost personal power plants because they were able to give
Yeah.
electricity back to the utilities. Any thoughts on this? I mean, what the administration could do to help lower some of these costs?
Well, I don't think they need them. I mean, I think the free can take care of that, or can take care of that, Todd. I'll be honest. And I think if you get Amazons and Googles and Metas and these large hyperscalers and to bring your own power, to enter into direct deals with the power providers, the power producers, at agreeable prices, there's room, there's margin to be made on both sides. The data centers can obviously still make money. They need power. Obviously, the power producers can charge a rate that they can make money on. And you think in the end, everybody wins, because if they build these power facilities, it will make the grid more resilient, the U.S. electric grid more resilient. We've been talking for years about the concern about the U.S. electric grid. In some ways, this will definitely help make the grid more resilient, but also help the U.S. win this global AI race as well by really being the leading power producer in the world. And I think natural gas will be the primary fuel behind that. And we can do all of that because of the low cost of electricity and the low cost of natural gas as the fuel supply.
Very smart point. I completely agree with you. Rob, this was a fantastic conversation. I want to thank you for joining me today. I know you're busy. Oil prices all over the place, so I appreciate you taking time today to talk to me, and I can't wait to have you back.
Thanks for having me, Todd. Thanks, everybody.
Absolutely. So on behalf of Rob Thummel, I am Todd Schoenberger. Thank you once again for joining us on The Money Path. Have a wonderful weekend, everyone. Catch on Monday. Lots of surprises, lots of great shows, and you definitely want to catch our newest show at 3 o'clock, Madden on the Line. It is a must-see episode. Take care, everyone.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.